What's up guys, welcome back to the Momentum Trading Lab, and in today's video I'm going to teach you about the ICT opening range gap and how you can incorporate it into your trading model. And with that being said, let's get into it. Okay, let's discuss what the opening range gap is. So the opening range gap is the area between the closing price when the futures market closes, that is at 4:15 in the afternoon for the Nasdaq and ES, and the opening price when the market opens at 9:30 a.m. New York or Eastern Standard Time. So if we have a look at this graphic, this was the very last candle that printed just before 4:15. So the closing price was right at 4:15, and then the next candle was at the opening at 9:30 in the morning for the following day. So the area between the close of this candle and the open of this candle is known as the opening range gap. So the important levels that I watch for the opening range gap is the high of the gap, the low of the gap, and the consequent encroachment of the gap, which is the midpoint from the close to the open. Okay, the next part is extremely important. So you won't be able to find the opening range gap without doing this part. So if you come down here at the bottom where it says ETH, if you hover on it, it will say electronic trading hours. So we want to click on that. Then it will bring up these two options, electronic trading hours or regular trading hours. So we want to select regular trading hours. Right, so once you have switched over to regular trading hours, then we will be able to see the opening range gap. Okay, so I'm on the 5-minute chart right now. Okay, so here we had a candle. So on the 5-minute chart, this candle started at 10 minutes past 4. So because this is on the 5-minute chart, the close of this candle would have been at 4:15. So then the very next day, when the market opened, this candle started at 9:30. So the open was right there. So what you can do is you can use your Fibonacci tool, and I'll quickly open my settings. So all you use is the 0, the 1, and the 0.5 for the consequent encroachment of the opening range gap. So this is the opening range gap. So from the close to the open for a bullish opening range gap. And as you can see, price action came straight to the consequent encroachment and then started to move away. Okay, let's have a look at a bearish example for the opening range gap. So right here, this was the very last 5-minute candle for this trading session. So the close was at 4:15 when the futures market closed. Then the very next candle was at the open for the New York session. So what we need to do is we need to pull our Fibonacci from the close to the open right there. So the close and the open, and the area in between these two levels is the opening range gap. And as you can see, price action retraced all the way to the top of the opening range gap, and then it started to move to the downside. Okay, so let's discuss how you can actually use the opening range gap to create your own entry model. So right here we have an opening range gap. So let's mark that off. So from the close of the very last candle of the trading session to the open of the first candle of the trading session, we have the opening range gap. And you can see how price action found support right at the consequent encroachment. So let's see how we can create an entry model. So for a lot of my setups that I trade, I want to see that rate on liquidity first before I do anything. So the opening range gap is going to be my point of interest. So if price action comes down into this area, I'm definitely going to be interested in a potential long position. But I want to see a rate on liquidity, which we had right here. So we had a low. So we had sell side liquidity below this low, and it also aligns with the consequent encroachment. So that is extra confluence. So now what we want to see is a bullish market structure shift. So how do we do that? So over here, we had a bearish market structure. And just before this impulse to the upside, this was the very last lower high. So if we displace above this level, that will be a bullish market structure shift. And then we can look for a potential long position if it comes back to one of our Fibonacci levels. So I use the candle bodies for this. And as you can see, it retraced into that OTE area around the 0.706. And then it went to the TPs to the negative 0.27 and the negative 618. And then eventually hit the one standard deviation. So that is how you can create your own entry model using the opening range gap. And the opening range gap will be used as a point of interest. All right, guys. I hope you enjoyed this video. That has been my explanation of the ICT opening range gap. If this video provided you with any value, please consider hitting that like and subscribe, and I'll see you guys in the next one.